$7,800 before they have to pay any regular income taxes. Now, the idea is you don't want to 1099 them. You actually want to fill out a W-2 for them. Because they're your child, if you send them a W-2, you or them are not subject to Social Security and Medicare. But if you pay them as a 1099 employee, then you will have to, they will have to pay their own Social Security and Medicare.
Oh, so I have to send out W-2s.
Exactly. And by the way, the W-2s are due January 31st, so you got to step on it.
Even though they are not salary people?
Well, that's the idea, is that if you do pay your kids, you've got to pay them as a W-2 employee. And most people think, well, W-2 employee, I'm going to have to pay all these payroll taxes. Well, that's precisely what I'm talking about, is that if you employ your children, you do not have to pay for Social Security and Medicare, which is payroll taxes.
Oh, okay.
So that dollar amount is $7,800 that you could potentially pay them.
Okay. But anything over 78, then I have to pay whole amount of medical and Social Security, right?
Oh, that's a good question. No. On all the payments that you make to your children, you do not have to pay any Social Security and Medicare. None whatsoever. So if you're over the $7,800 amount, they will wind up paying some taxes on it. Let me give you an example. Let's say that you gave them $10,000 of a W-2. Their personal deductions, personal exemption and standard deduction come out to about $7,800. They'll pay taxes on the rest, $200 at the 10% tax rate. That's $220. Not much.
Okay. What if it's you employ other people who are less than 18 or 20 years old?
Well, here's the question on if you have someone that you employ. Now, is that a child of yours or someone else?
Someone else.
Someone else? You can pay them any way you like. If they're under 16 years old, there's some regulations you've got to deal with as far as their school and signing off whether they're allowed to work for you or not. But if they're over 16 and a half and under 18, there are no regulations. You can just employ them.
Oh, okay.
And there wouldn't be a Social Security reduction on that.
Oh, SS. Okay, reduction.
Just on your children. They've got to be your blood dependents.
Oh, just for. So if someone else, if I hire, then I have to pay their Social Security and medical?
Exactly. Yeah, exactly. So if you're employing someone, regardless of their age, and they're not your kids, then you do have to pay for their half of their Social Security and Medicare, and you've got to do W-2s. You've got to pay for the state unemployment, the federal unemployment tax, the whole 9 yards.
So, John, if they're aged, though, if they're under, 17 or 18, does the income cap still apply to them if they're not related?
No, it does not.
It does not. So only if you're related.
$100,000 if you wanted to.
Okay.
So
I see.
It doesn't matter. Now they'll have to prepare their own tax returns, and when they prepare their own returns, then they'll have to figure out whether or not they owe taxes on their side.
I see. So if you're employing your child, your flesh and blood, then and what's the age limit again? At 18?
18 and over, there's no issues. Under 18, there is limitations.
Limitations. Okay.
And I have another question. Is that, and I don't know you're familiar with it or not. What about foreign investor? They invested in one of my partnership that I need to pay K1, and then they have a SS number here, but they do not live in this country. In their case, how they file income tax?
Well, here's what the state of California and the government here in IRS does, is that you've got to withhold for foreign tax owners.
Mm-hmm.
That means you've got to withhold some taxes of whatever profits the company has, so that they don't skip town and not file their returns here. So now it's making sure that those people file their returns here, and if there's a refund, then they get it back. If there's tax to pay, then they'll get a bill.
So she could be liable for that person's taxes, right, John?
You know, you said that exactly right, Eric. The partnership itself, which happens to be you, I believe, you're responsible for withholding. So if the person skips town and you didn't withhold, it's all on you.
Mm-hmm.
So, I mean, my CPA talk about maybe she has to file the worldwide income tax. I don't know what that is, but
for California, it's called Worldwide or California's Water's Edge election.
Oh.
She can do something of that sense,
Something
but
like that.
in a general perspective, you do have to withhold for her, and it will depend on her worldwide income.
Jamie, it sounds like you and John should get together.
I am. I do. Okay.
Thank you for calling and being a part of the Powers Now.
Thank you.
Operator, next question.
Our next question in the queue is from Lily. Please go ahead.
Hi, John and Eric.
Hey, Lily.
Hi. I think that you actually covered it because my question is, under technology and for my social networking, my 14-year-old nephew is just so much better at this than I am. And so I've hired him to do that, but you've just covered it, that it has to be one of your children in order to be able to get the take advantage of how the tax laws are set up, correct?
That's right, Lily. You are correct. So it's got to be your own child.
Okay.
And by the way, the reason why this regulation stands, it's because why should you pay taxes, especially Social Security, Medicare, twice in the same family household?
Mm-hmm.
So that's why they do it this way.
Okay.
But so nephews and nieces, that doesn't work out.
Okay. Well, great. Thank you so much.
You're welcome.
Thanks, Lily. Next question, operator.
Our next question in the queue is from Guadalupe. Please go ahead.
Hi. My question was that you mentioned that if somebody files bankruptcy during the short sale or foreclosure, then they're completely off the hook. And I just wanted to make sure, is it during the short sale or foreclosure process, or can this be done afterwards?
Good question, Guadalupe. And I went really fast on that, but here's the details, is that if you're in a foreclosure and part of your bankruptcy shows the bank institution that you still owe as one of the creditors that's going to go through the bankruptcy, then you're okay. The problem is very, very bad when you actually go through the foreclosure, finalize the foreclosure, and then claim bankruptcy, because the IRS's taxes are not allowed to be discharged in any bankruptcy other than a 13 in some situations. But you're stuck with the tax dollar amount if you've done the foreclosure first and closed it and then go into a bankruptcy. What you want to do is make sure that the foreclosure and the bankruptcy correlate together so that the loan is inside the bankruptcy.
Okay, perfect. All righty. Thank you so much.
Very, very good question.
Thanks for calling. Next question, operator.
Our next question in the queue is from Sue. Please go ahead.
Yes, thank you very much. This is so interesting, and I'm trying to take notes and listen at the same time, and I'm not good at that. But I would like to go back to the part of the penalties and benefits if you're single, and if you're just starting out in real estate. I wasn't sure I stopped what would happen on that.
Well, if you're a single person, you're basically being taxed at your individual rate and for Social Security benefits whenever you have your own small business, that so to speak. So the penalty I was talking about is that you get to the higher tax dollars or higher tax brackets a whole lot faster than if you were married and your partner did not have very much income. But all in all, your tax rates are basically the same as everybody else. Just to give you an idea, from $0 to $8,500, you're taxed at the 10% bracket. From $8,500 to $3,400 at the 15% bracket. $3,500 to about $84,000 is 25% bracket, and it just keeps going up from there.
Okay, well, good. I think that covers it, and the health part of it, too, that you were talking about. Would you review that part on
Definitely. So there's you mean the health care credit?
Uh-huh.
The health care credit is for those people who you employ. If you have employees and you pay for their health insurance, you could get a credit of up to 35%. And you know what? One thing that I didn't say is that it doesn't count on yours. The owner's health insurance is not subject to this credit.
Okay. Just the employees.
Just the employees. If this is a corporation, all of the shareholders must be omitted from this calculation.
Hey, I was asking that question for someone I know that does employ, and I couldn't write fast enough on that. So, well, good. You just answered my question. Thank you. This was excellent.
You're welcome.
Well, thank you for calling. And, don't worry about taking notes. This call is being recorded and will be available on Facebook.com/Power is Now. Facebook.com/Power is Now. And please link up with me at Facebook.com and also at LinkedIn for future announcements on Power is Now teleconferences. Operator, next question.
And again, as a reminder, if you'd like to ask a question or have a comment, please press star then 1.
Hey, Erica, I forgot to say is that you probably have a couple of other of my my webinars that you had done with me before, and that goes really into detail into the short sales and foreclosures.
John, you're absolutely, I do have those. In fact, we're launching, folks, I believe it's going to be around the second week of February, the Power is Now website. And it will be just that, thepowerisnow.com. And you will be able to go to that website and listen to all the past calls. Today is show number 71, John, 71 teleconferences. And I'm so proud that we have had incredible guests like yourself come on the show and share your valuable information, and it is definitely a resource. So, folks, if you are listening to this call for the first time, please lock us in on your Outlook and your calendar, same telephone number, and if you can't get on the call live, just know that you'll be able to listen to the recording at Facebook.com/Power is Now. And please tell others about the teleconference. This call is a nationwide call. We have listeners all over the country, and our speakers are really addressing issues that affect everyone, regardless of where you're located. Operator, do we have any more questions?
We do. Our next question is from Olivia. Please go ahead.
Olivia?
Hi, good morning.
Good morning.
My question is, I have a listing for a short sale, but these people, they've been struggling for 2 years already, so they have done all the loan modifications, so they had to do the bankruptcy, and I think they just being clear off on November, this past November, and the listing is now the short sale. If they go through the short sale, would they be still off the hook on regarding taxes on the amount of, they're all from the loan?
That's a good question. So you've got to make sure that the loan, the mortgage company, was named as one of the creditors in the bankruptcy.
Okay.
If that was the case, regardless of if the short sale occurs 2-3 years down the road, it's still going to work out just fine.
Okay. Okay. Thank you very much.
You're welcome. Good question.
You're welcome. Operator, let's take one more question.
Sure. Our next question is from Guadalupe. Please go ahead.
Hi, I had already previously asked a question, but I remembered I had another one. Okay, as far as, say, for example, a short sale or a foreclosure on a rental property, I have some rental properties and I take depreciation every year for those. How would that be handled if I were to do a short sale on one of my rentals?
Good question. A short sale is exactly what it says. It's a sale. So there's two parts of this puzzle here. Number one, we've got to address the sale of the property. And whatever you sold the property for minus what you originally purchased the property plus any depreciation that you had taken in the past will be your either gain or loss. And then we also have to take into consideration the mortgage aspect of things. So we take the mortgage minus what the property sold for. That's your discharge in debt. In most situations, especially those people that bought in 2005 through 2008, they're going to wind up having a tremendous loss as far as the property is concerned, but they're going to wind up having gain on the discharge of debt. We have to take those two into consideration. From a lot of my clients, they've actually wound up having a loss all around that they would be able to use on their personal tax return right away, which is a benefit for them.